Right, Bank Muamalat Chief Economist Dr. Muhammad Afzanizam Abdul Rashid described Bank Negara's decision to keep the overnight policy rate at 2.75% as steady and well-calibrated, reflecting confidence in Malaysia's economic momentum while keeping monetary conditions supportive without triggering inflation. Speaking to Bernama TV, he said the move provides households and businesses with predictable borrowing costs, supporting consumer spending and business confidence amid stable employment, rising wages and ongoing investment projects.
Having said that, Bank Negara also put some caveats that the downside risk continue to revolve around the external sector, namely the uncertainties with regards to the trade policies, as well as the potential reduction in the global commodities productions. Therefore, given such a positive assessment by the central bank, we opine that the OPR is likely to remain at 2.75% throughout the year, barring any unforeseen circumstances. And we also believe that the prevailing OPR level is appropriate to promote economic growth, at the same time to keep the risk of high inflation at bay.
Meanwhile, IPPFA's Sidek Jantan said the decision aligns with his Malaysia Outlook 2026 thesis, noting growth above 4% is driven by strong domestic demand, labour market resilience and investment realization rather than excess demand.
In this context, any near-term inflation firming arising from STR disbursement and phase 2 of the SSPA should be interpreted as a demand normalization effect rather than a structural inflation risk, particularly given that production costs, global input prices and supply conditions remain stable. This reinforces our view that inflation pressure remains anchored, cyclical and manageable, weakening the justification for preemptive monetary tightening at this stage of the cycle.
He noted that maintaining the OPR at 2.75% preserves financing predictability, supports multi-year investments and safeguards policy flexibility against global uncertainties. Meanwhile, M-Bank Chief Economist Firdaus Rosli said Malaysia's economy is expected to remain resilient in 2026, with growth projected at 4.5%, supported by strong private consumption and a boost from tourism. Speaking on the economic outlook, he highlighted that solid domestic fundamentals, including government cash assistance programs, continue to sustain household spending and ensure wider participation in growth. Firdaus also said the government's target to reduce the fiscal deficit from 3.8% in 2025 to 3.5% in 2026 is realistic, provided there are no unexpected fiscal pressures. On the currency front, he noted the ringgit may dip below 4 against the US dollar later in 2026, as the timing of US Federal Reserve interest rate cuts becomes clearer.